We're just saying how COVID has reshaped the world of credit investing. How has it? I mean, is there, we keep hearing this wall of cash, desperate to find a home. Is everything very overvalued?
Yeah, well, there's two questions there. One is there's a wall of cash. I think, look, generally in alternatives, there has been an increase in growth of that area over the past 10, 15 years. In private credit in particular, the market has moved from roughly 300 billion in 2008, 2009 to over $1 trillion today. So there's been 10 to 12% growth. But when you put that on the backdrop of what overall equity and bonds are in the public market, which is like 200 trillion. I mean, it pales in comparison. And I think there's been a number of things that have driven that over the past several years, which is one, we're a lower rate environment, have been in a lower rate environment for quite some time. And people are rotating out of fixed income into private credit to pick up that yield in their portfolios. We've also seen more public companies go private and stay private longer. So there's twice as many private companies owned by private equity today than there are public companies, and so they're looking for private capital. And then finally, the banks over the past decade have really been retrenching from the leverage lending aspect of the markets. So, private capital has come in to fill that void, if you will.
But has it driven valuations too lofty? Are things, quote unquote, too risky when you have, as you say, more private opportunities and more money going into it trying to seek yield?
Yeah, I think that there's two components. One is valuations, we would say, across all asset classes today, they're high, right? And we're seeing that in the equity markets in particular. That's a good thing for us from a credit perspective.
Why?
Because it gives us a bigger margin of safety, a bigger cushion, if you will, for the lending that we're doing. So if you actually looked at pre and post-pandemic, equity cushion has actually increased materially since 2019. So that's a good thing. Secondly, cash flows are up for corporates. Cash flow coverage is up, leverage is up on an EBITDA basis, but the coverage ratios are up tremendously because of the growth you've seen on the top line and the bottom line over the past 12 months or so. Okay. So I think from that perspective, we feel pretty good. If you look at what I really look at and what investors are looking at is what is that spread between the public market alternative and the private? And that has stayed relatively stable to increased over the past 12 to 18 months. And depending on what asset class you're looking at, but take direct lending, it's been roughly 120 to 130 basis points of pickup from going from a public alternative into a private alternative. So I think the value is still there for investors.
And of course, you're long-term investors to a large extent. Do you look through cycles? I mean, does it matter to you whether everyone's now thinking the Federal Reserve is going to tap on the brakes?
Yeah, I think it's, look, interest rates are relevant, I guess, in terms of what is that going to do to valuation, most importantly, and we all know that. So we look at that. But I think there's two things to consider. One is the majority of our products are floating rates, so they're basically short duration. So as rates go up, as long as you're in good companies with good credits, then you're benefiting from that. Number two is that we are, people, our investors are looking for us to invest through cycles, not at points in time in the cycle.
They're not buying the dip.
They're not buying the dip. I mean, we do have some strategies that do that, obviously, and we were able to pivot on our platform to do that. But by and large, I mean, people are looking for steady, persistent returns through cycles. And that's what we're supposed to deliver, right? So it's the expectation of what do you have in your policy portfolio as an overall investor, because we're just one component of a very large portfolio for many of our investors.
Those portfolios of investors are now becoming more attuned to, well, where they want to put money from a moral perspective, from a aligning with their value perspective, ESG, dare we say it, environmental, social governance. Is there enough transparency in this space? Are you able to measure the impact that some of your offerings have?
Yeah, I think it's like I say with the hybrid work environment. Like, what does that mean? Can you explain what that means?
What does it mean to you?
It means, for me, it means 3 days a week in the office, 2 days working somewhere else, and we stuck to that. But I think generally, it comes down to measurement and standardization. And as you noted, I think in some of your prior sessions that we basically teamed up with CalPERS to have a convergence of data on ESG and how that's measured across private asset portfolios. And that's just one way we as a firm are trying to drive that forward. But I think from a firm perspective, what we said is ESG has to permeate all of our investments, all of our portfolio companies on the private equity side, all of our credit investments. And in credit in particular, what we did is we came up with a ESG risk framework using SASB, which is the Sustainability Accounting Standards Board. dashboard framework to help us measure and identify risk in our portfolio and put a risk rating on it so that we as portfolio managers can identify the risk going in and what we hold in our portfolio. And importantly, we've just recently raised a $2 billion credit facility for global credit that is tied to those metrics. And so in fact, if we're performing well, then that will lower the cost of that leverage line that we're using on behalf of our investors. So it's a real way to demonstrate the power of ESG.
And incentivizing it.
Incentivizing as well.